Hello students, in this video I would be discussing December 2023 question paper with respect to direct tax. Let us see how the question paper was and what type of questions are asked and what are the solutions for the same, guys. So as you guys know, the time allowed and all is for full complete paper. Whatever I would be discussing in this video is with respect to direct tax, but the entire question paper, that is both for direct as well as indirect, both part put together is for 3 hours. So total number of questions is 6. First we'll see part 1, but before part 1 guys, some notes are given. Let me just go through it once, answer all the questions. Okay, all the references to section in part 1 of the question paper relate to the Income Tax Act 1961 and relevant assessment year 23-24 unless stated otherwise. Guys, see, this question is for December 2023 exam. So the relevant finance act was Finance Act 2022. Okay, so accordingly the previous year was 22-23 and assessment year was 23-24. Means any questions asked in this paper would be for previous year 22-23 or assessment year 23-24, guys. But whatever I would be discussing would be as applicable for June and December 24 exams. 24 exams means the applicable Finance Act would be Finance Act 2023. Yes, so then what would be the previous year 23-24 and what would be the applicable assessment year 24 or 25. Clear? So any questions whatever I would be discussing is with respect to whatever is applicable for June and December 2024 exams. Fine. So if there is any change in the provisions or amendment, accordingly I would be explaining it, guys. Clear? Yes. Then all the references, this is with respect to part 2, that is the indirect tax. Wherever necessary, suitable assumptions can be made and the same be stated clearly in your answer. Working note should form part of the answer. As you guys know, it is a descriptive type, so your answer should contain all the notes and working notes required, guys. Yes. And before I start, guys, one more disclosure which is very important for direct tax purpose. Now, previously there was something called as, guys, old regime, new regime, or old scheme, new scheme. And now they are not called old regime and new regime. They are called default regime and the optional regime. Whatever was called new regime now has been named as default regime, which is actually in section 115 BAC. Previously it used to be called as what? The new regime, or we used to call it as what? The optional regime. Yes, sir. So what was the old regime or old tax system? This was as per the provisions of the income tax. Yes. But now this is called optional scheme or optional regime. This is called optional regime or the optional scheme. So every assessee, it is understood that, means slab rate assessee, it is understood that they are following default regime. If they don't want to follow default regime because they cannot claim certain exemptions and deductions, they can opt out of 115 BAC default scheme and they can follow optional scheme. And optional scheme is nothing but as per the regular provisions where you are free to claim exemptions and deductions, guys. Is that clear? This one small clarification you should know, especially for those students who would have already appeared for the previous attempts and all. So you should know this main difference, guys. This is one of the major difference as per Finance Act 2023. Okay, let us start with question number 1. Vijay, an Indian citizen, was living in Delhi since 1972. He left for France on 1st August 2017. Okay, so he is leaving India to go and settle where in France on 1st August 2017 and come back to India on 2nd April 2022. That is during the previous year. I told you any question given is for previous year 22-23. Accordingly we will answer, guys. Accordingly we will discuss the answers. But if there is any change in the provisions and all, I will be mentioning it. Clear? Yes. So he came to India during the previous year. Okay. On the same day, he joined BGH Industries Limited, Delhi as a chief mechanic. He went to China for 15 days during the year in the month of July. So he was outside India for 15 days. Okay, during previous year. He furnishes the following details for the previous year 22-23 about his salary income. Basic salary 1,22,000 per month. Dearness allowance eligible for retirement benefits 60,000 per month. Fixed medical allowance 5,000 per month. House rent allowance 25,000 per month. Transport allowance 2,000 per month. Fine. This is with respect to salary details. So some more informations are there. Bonus, 2 months basic salary plus DA. Club membership fee reimbursed by employer, means employee has incurred it but later reimbursed by employer, 14,000 per annum. Residence telephone bill paid by employer, it is nothing but perquisite, 22,000 per annum. Contribution of employer to recognized provident fund, which is 15% of basic salary plus DA. Please be careful guys, for recognized provident fund it is exempt but only up to 12%, but here it is 15%. Fine. Next, 2 children of Vijay study in the school run by a company, that is the employer. The cost of education in the similar school for the year would be 1,24,000. Up to 1,000 means it would have not been taxable, but here it is actually 1,24,000. Okay, and the employee paid 50,000 to the school by way of fee. Okay, that means what is the net benefit is enjoying? 1,24,000 minus 50,000, 74,000. What is the net benefit is enjoying? 74,000. Will this be taxable in the hands of employee? Yes. Okay. Next, Vijay gives the following information with respect to 2 loans taken by him from scheduled banks for various purposes. He has taken 2 types of loans. What are those? We will see. A housing loan of 34 lakh taken on 12th March 2022 for the purpose of for the purchase of house to be used for self-residence. Okay, self-occupied, at a cost of 44 lakh. Okay, loan amount is 34 lakh, but he has purchased the house for 44 lakh. The stamp duty value of the house is 41 lakh. Important, because to claim one deduction for interest, this limit is there. At the time of purchase, amount of repayment of loan during the previous year 22-23 was towards principal 1,22,000, towards interest 3,60,000. This is the first and only residence house owned by Vijay. Okay, this is the information. Now second loan, a vehicle loan of 18 lakh taken on 29th May 2022 for the purchase of new electric car for personal use. Amount of repayment of loan during the previous year 22-23 was towards principal. He has taken vehicle loan to purchase new electric vehicle, electric car. Please be careful. Towards principal 80,000, towards interest 1,75,000. Okay. Beside these loans, he also has paid a sum of 9,000 to a political party as a contribution. The entire amount has been paid in cash. So if he has paid in cash, can he claim deduction? No. 80 GGB and GGC talks about the political contribution. Here the person who is giving it is not a company. So he can claim it under which section? GGC. So now, is he eligible to claim? No sir. As he is giving it in cash, he cannot claim. Next, based on the facts of the case scenario given above, answer each of the following 3 parts treated as separately. Means each part you have to treat it as separately. There are 3 sub questions, 5 marks each. 5 marks each. Let us see one by one. Determine the residential status of Vijay for the assessment year 23-24 along with detailed workings. Guys, for this only the information given here is important. Only first para. That's all. Nothing else you have to look into. What is the story? He was in India since 1972. He left for France on 1st August 2017. Why he is leaving also they have not mentioned, and comes back on 2nd April 2022. So there is almost 5 years gap guys. So obviously you would have been engaged somewhere outside India, that is in France, for the purpose of business, employment or profession. Okay. And when he is coming back, they are not mentioning for what purpose he is coming back. That is it for a visit and all. So please be careful with it. On the same day he joined the company as an employee. So he is not coming here for a visit. He is coming here for a employment. Please be careful. Okay. As a chief mechanic, fine, and he went for 15 days to China during the previous year. This is the only information given guys. Let us see the solution. Residential status of Vijay for assessment year 23-24. Check the first basic condition, that is stay in India for a minimum period of 182 days or more during the previous year. So for this question, what is the previous year guys? Please don't get confused. For your exam, applicable previous year is 23-24, assessment year is 24-25. But in this question paper, whatever questions has been asked is for which year, which previous year, 22-23, or assessment year 23-24. Clear? So whatever data they have given, accordingly we are solving it. But if at all, if there is any amendment or change in the provisions, I would mention it. Clear? Yes, sure. 182 days or more during the previous year. Mr. Vijay has stayed in India for how many days? 349 days. Sir, how did you get it? 365 is the total number of days. In that 15 days he was outside India, he went to China. Yes. And he came to India on 2nd April. So even 1st April we have to exclude. So totally how many days he was outside India? 15 days for China. And he came to India on 2nd April. So 1st April he was not in India. So totally 16 days. So 365 days minus 16 days. Remaining days, it is understood that he was in India. Okay, how many days? 349. So did he satisfy the first condition given under section 6.1? Yes, he has satisfied. So this test is satisfied. So Mr. Vijay is a resident in India during the previous year 22-23. Keeping in view the fact of the given case, Mr. Vijay satisfies the 2 additional conditions, also namely, he is a resident in India in 2 out of 10 previous years preceding the relevant previous year. Okay, we have to check section 6.6 additional conditions also. What are those 2 additional conditions, guys? 6.6 additional conditions. First one, you should be resident in at least 2 years. Out of how many years? 10 years. Out of 10 years. Guys, just by applying common sense, I can tell easily that yes, he has satisfied. Why, sir? Simple. When did he leave India? In 2017. Before that, it is understood that he was completely in India. Yes. So, if you take last 10 years, leave in between 17 to 22, you live. Before that, he was completely in India. Yes, sir. So, obviously, in those years, you would have satisfied the condition given under section 6.1, that is 182 days or more. Yes. So, at least 2 years he is resident. Yes, sir. More than 2 years, he would have been resident in India. Okay. Then, second condition is what? 730 days or more during 7 years. During 7 years preceding the previous year. While counting the 10 years and 7 years, we should not check the previous year. We have to check the preceding previous years. Okay, sure. Let us see how they have given. So 21-22 previous years. So we should not consider 22-23, guys. 22-23 is only for previous section 6.1 conditions. Whereas for 6.6 we should always check the past history. So 21-22, how many days he was in India? He was not at all there. 20-21, not there. 19-20, not there. Then 18-19 also he was not there. 17-18, in between the year he left. So how many days he was in India was? I will just show you. 1st August he left, guys. So April full, May, June and July. This 4 months completely was in India. Plus 1st August also we have to count. That is the day he is leaving India also is considered to be in India. So you can see here April, May, June, July plus 1 day in August. So in 17-18, how many days he was there in India? 123. Then 16-17, 365. 15-16, 366. Even if you take before that also, he was completely in India. Sir, here why 366, sir? Because 2016 is a leap year. Is a leap year. Okay. Guys, just by seeing this 2, we need not even go before that. We can easily tell, sir, in these 2 years, you would have satisfied the condition given under section 6. Yes. So you would have become resident in India. Yes. So you can see here, resident. Even in this year we can see, but no need. Okay, because you can check how many years is over. 1, 2, 3, 4, 5. Okay, even if I leave that 5 years, remaining 5 years, he was completely in India. So obviously would have been resident in those years in India. Yes, sir. So 2 years taken care. Fine. Next 7 years you check. So 7 years preceding the previous year we have to take. Okay. Sir, this 4 years he was completely outside India. Fine. This year partially in India, partially outside India. Fine. Then this 2 years he was completely in India. So if you count the number of days, it is more than 730 days. It is more than 730 days, guys. So that means he satisfied both the condition given under section 6.6. Yes. Hence, Mr. Vijay is a resident and ordinary resident in India during the assessment year 23-24, guys. Is that clear? Yes. And sir, is this calculation and all required? In my opinion, this is not required, guys. Stay during preceding 4 previous years and all is not required, because here it is clearly known that before this, before 17-18, he was completely in India. So definitely will satisfy the first condition given under section 6.6. That is, he should be at least a resident in 2 years out of last 10 years, guys. Clear? Yes. But See, please be careful. Days calculation and all you show properly, because they have clearly asked in the question. They have clearly asked in the question that determine the residential status of Vijay for assessment year along with the detailed workings. So don't simply write the number of days. Please also show how you derived that. Okay, like 30 plus 31, like that. However they have shown in the answer, you also try to show it. But this part I suggest don't want. Okay, this one, even this is not required. You can straight away answer for those provisions, guys. Okay, chalo. Let us go to the second one here. Compute the income from salary of Vijay for assessment year 23-24 on the assumption that he has opted the scheme of section 115 BAC. Means he is following BAC. What that scheme is called now? Guys, come on, default scheme. So if he is following default scheme, can he claim chapter 6A deductions or any other exemptions and all? No. There are certain restrictions, guys, which we already covered in our regular class. Okay, we will see. Salary income, basic salary, everywhere it's better you show. Per month is given into 12 into 12. Please show and write the amounts. Dearness allowance, fixed medical allowance is always fully taxable. HRA under section 1013A, can he claim the exemption? No. When he is under default scheme, he cannot claim it. He cannot claim it. Then transport allowance covered under section 1014, not eligible for exemption. Why, sir? Because this person is not a handicapped person. Transport allowance is allowed only as an exemption for a person who is physically challenged or handicapped. So that exemption is not available. That means fully taxable. Bonus 2 months salary and DA, whatever is there, this is for 12 months. So divided by 12 months. Whatever you do, okay, means for example, add up both of this, divided by 12 into 2, guys. Into 2. It will be like this. Let me just show it. Everywhere the amounts are written directly, but you please don't do like that. This is for a year. How much we have to take? For 2 months. For 2 months, guys. Okay. Next, club membership fee reimbursement not exempt, assumed for private purpose of the employee. Means the employer has paid it and later employer has reimbursed it. So we are assuming it to be personal, so taxable. Then residence telephone bill, which is a perquisite, which is completely exempt perquisite, guys. Then concessional education, I told you, as the cost of education is more than 1000 rupees, entire amount would be taxable. But here, employee is paying 50,000. While valuing any perquisite, if anything is recovered from employee, please reduce it. Check what is the net benefit the employee is enjoying. Only that would be taxable as perquisite in the hands of employee. Employer's contribution to PF beyond 12%. So it is actually contributed 15%. How much is exempt? Up to 12%. Remaining 3% is taxable. So here 3% of what? Basic pay plus DA. Clear, guys? Means employer contribution is 15% of basic pay plus DA. But how much is exempt? 12% of basic pay plus DA. For DA condition is satisfied. So we are taking it. Okay. So they have calculated the amount. So they have taken basic pay plus DA, 3% of that. 3% of the same, guys. Then gross salary we will get. And one important thing, guys, standard deduction was actually not allowed previously. But now under default regime it is allowed. Under default regime it is allowed. Please be careful. Previously this was blocked under the new regime. But now under the default regime, that is as per section 115 BAC, standard deduction is allowed. Standard deduction is allowed. Please be careful. So the taxable income from salary comes to 30,35,520. I don't know why they have rounded off. No need to round off, because only total income has to be rounded off to nearest to 10 rupees. Here they have rounded off to 100 rupees. 520, please keep it like that. Actually, we should never round off the income under each head. We should round off only the total income, that too, to the nearest to 10 rupees as per section 288A. But here they have given it as 500, which is not correct. So please be careful. This is your final answer. This is your final answer, guys. Fine. Let us go to the last sub question here. With reference to the loan taken and contribution to political party, compute the amount of tax benefits deductions available to Vijay under various provisions of Income Tax Act 1961, so that he gets the maximum benefit, assuming that it does not opt to pay tax under default regime. That is, he is not following BAC. That means what is he doing? He is opting out of BAC and following optional scheme. That is as per regular provisions. In that case, can he claim chapter 6A deductions and interest on a self-occupied house and all? Yes. But if he is following default, the amount of deduction would be 0. The amount of deductions would be 0, guys. But here they are telling that is not following 115 BAC. That means he is opting out of it. Chalo. So under section 24B, for interest on housing loan for self-occupied property, what is the maximum interest allowed? 2 lakh. You can claim it as a loss. 2 lakh, fine. Next, deduction under section 80C, that is for the principal repayment of housing loan. How much you are paying? 1,22,000. Can I claim full? Yes, because it is within the limit of 1,50,000, you can claim it. Then deduction under section 80EEA, this is important because it has lot of conditions. You can see stamp duty value does not exceed 45 lakh and Mr. Vijay does not own any residential house because 80EEA clearly tell it should be your first house. And so Mr. Vijay is eligible for deduction of up to how much? 1,50,000 in respect of such interest on loan, which is not claimed under the property head, because under house property you have claimed 2 lakh, but actually your interest is how much? 3,60,000. So still you are left with some amount, which is not claimed under the head house property, since loan is sanctioned between 2019 to 31st March 2022. So within this period loan has to be taken. Now the period is already over, but guys, loan has to be taken within this period. If loan is taken within this period, if stamp duty value is less than 45 lakh and if other conditions are satisfied, like it should be a first home and all, then even after this you can claim deduction for interest, but loan period should be within this period. Clear up? Yes. So 3,60,000 is the total interest. In that already 2 lakh we have claimed here under the head house property. Remaining was how much? 160. Can he claim full 160? No. Under section 80EEA, maximum interest allowed is 1,50,000. If you are paying less than that, you can claim only that much. But here actually amount is coming to 160, remaining amount. But can you claim full 160? No. Maximum deduction under section 80EEA is 1,50,000. So they are restricting it. Now you can ask me, sir, can I carry forward remaining 10,000? No, you cannot. Next, deduction under section 80EEB, that is for the vehicle loan, deduction for interest on loan for purchase of electric vehicle of rupees 1,75,000, restricted to again how much? Maximum 150. Even under section 80EB, for the loan which you have taken to purchase the electric vehicle, maximum deduction which is allowed for interest 1,50,000. Being the maximum permissible deduction since loan is sanctioned between 1st April 2019 and 31st March 2023. No deduction in respect of principal repayment of loan for purchase of electric vehicle. Please be careful. This is for electric vehicle. Don't get confused. For the electric vehicle, you should have taken the loan in between 1st April 19 to 31st March 2023. If you have taken the loan in between this, you can claim interest deduction even after that. So during the year, how much interest he paid? 1,75,000. But can he claim full? No, only 150. Sir, what about the principal? Did he pay any principal amount? Let us just see. Yeah, principal amount also he has paid 80,000. Can he claim deduction for it? No, he cannot claim any deduction for it. Whereas for housing loan, principal repayment, you can claim it under section 80C. But for vehicle loan, that facility is not there. Okay. Next, deduction under section 80 GGC. GGP is for a company, GGC is for others. Can you claim there? No. As you are giving it in cash, you cannot claim. So what is the total deductions under chapter 6A? 422. This is under chapter 6A. Whereas under house property, how much you are claiming? 2 lakh. So total is how much? 6,22,000. Total deductions. This is not under chapter 6A. Please be careful. Under chapter 6A, only 4,22,000. Sir, assume in the same case, what if the assessee was following default regime? This amount would have been nil, guys. Interest on self-occupied property is also not allowed. Plus, chapter 6A deductions also are not allowed. So, entire amount, what he can claim is blocked. So, that means he can claim nil amount. Okay, question number 1 done. Question number 2. BAC and Co is a partnership firm which sets up a new industrial unit in Noida. It incurs the following expenditure. So they are setting up a new industrial unit or branch. It incurs the following expenditure in connection with the new unit. Preparation of project report, market survey, and the amount is coming to 9 lakh total amount. What do we call this amount as, guys? Preliminary expenses. Following further informations are available. Cost of project and capital employed in the new unit is given. Compute the deduction admissible to the firm under section 35 AD. Firm is the assessee here of the Income Tax Act 1961 for the assessment year 23-24. Guys, for claiming the amortization of preliminary expenses under section 35D, there are two categories of assessee. One is Indian company, then the others who is resident in India. Here firm is falling on which category? Others category. Others category. Okay. Let us see the answer. Qualifying amount for deduction under section 35D. In case of a firm, preliminary expenditure is restricted to 5% of cost of project. Means we will compare actual preliminary expenses with 5% of cost of project. Sir, here should we take 5% of capital employed? No, that is only for companies. Here who is the assessee? Firm. So for 5% of capital employed, should we take it here? No. Take straight away 5% of cost of project, compare it with actual preliminary expenses, and you consider whichever is lower, 1/5 of that you can claim it over a period of 5 years. Clear? Yes. Further, no deduction shall be admissible unless the accounts of the assessee for the year or the years in which the expenditure specified is incurred have been audited by an accountant, that is chartered accountant, as defined in explanation below, subsection 2 of section 288, before the specified date referred in section 44 AB. Means what is the specified date, guys? Sir, 1 month prior to the due date of filing the income tax returns. So for those assessee for whom tax audit is applicable, what is the due date? 31st October of the assessment year. 31st October of the assessment year. So 1 month before that means which month? What is the date, sir? 30th September, guys. 30th September. Okay. And the assessee furnishes for the first year in which the deduction under this section is claimed. The report of such audit by that date in the prescribed form, duly signed and verified by such accountant and setting forth such particulars as may be prescribed. Hence, eligible preliminary expenses is 2 lakh, which is 5% of cost of project. Cost of project is given as 40 lakh. Take 5% of that, which is 2 lakh. Actual preliminary expenses is how much? 9 lakh. So compare both of this. Whichever is lower, 2 lakh. Sir, can I claim it in one shot? No, 5 installments. So quantum of deduction. Further, eligible preliminary expenditure is deducted in 5 equal installments, beginning with previous year of commencement of business or previous year in which the extension of the undertaking is completed or the new unit commences. In our case, new unit. Production or operation. Therefore, the deduction under section 35D in respect of preliminary expenditure for the assessment year 23-24 is 40,000. How did we get this 40,000? 1/5 of 2 lakh. 1/5 of 2 lakh. Okay, now yes. So this is actually the calculation, but whatever they have explained in first paragraph is with respect to procedural compliance, guys. That is, whenever you are claiming the deduction for preliminary expenses, you have to get a proof from a chartered accountant signed by him, like audit report. Yeah, let us move to the B part. Varun has 2 let out properties. The details for the year 22-23 are given as under. Municipal value, fair rent, standard rent is given. Actual rent also is given. They have made your work very easy. You have to just do the comparison stepwise. Municipal tax due for the year. Municipal tax of the past years paid during the year. Guys, municipal tax is allowed on accrual basis or payment basis? Payment basis. So what is paid is allowed. Okay. Interest on money borrowed current year paid. Okay. Interest on money borrowed current year not paid. Guys, interest is allowed on what basis? Accrual basis. So paid as well as not paid, both is allowed. Yes, both are allowed. Both are allowed on accrual basis. Sir, here now this not paid I am claiming in the current year. In the next year I will pay this. Can I claim it again in the next year? No. Double benefit you cannot claim. Here, so please have this in mind. Municipal tax is allowed on payment basis. Paid by whom? Owner. If it is paid by tenant, no deduction. And here they are not clearly given. So it's all, if they just mentioned municipal tax paid and all, always assume it is paid by owner. Next, interest on housing loan is allowed always on accrual basis. Whether you have paid it or not, it is always allowed on accrual basis, guys. So here, sir, this paid figure, is it for current year? Yes, they have clearly mentioned for the current year it is paid. And for the current year, there is also an amount which is not paid, which is accrued but not paid. Okay. Compute the income under the head house property in the hands of Varun for the assessment year 23-24, assuming none opted to pay tax under section 115 BAC. Assuming none opted to pay tax under 115 BAC means he is not following 115 BAC. Means what is he following? Optional scheme, guys. Okay. Chalo. We have to follow the steps. First, we have to derive gross annual value. You can do this by way of working note also separately. First, we will compare municipal value with fair rent. We will take whichever is higher. Then we will compare that with standard rent and we will take whichever is lower. Then we will compare that with actual rent and take whichever is higher, guys. Whichever is higher. That is actual rent compared with the reasonable rent or expected rent, we call it as. Clear? Yes. So, GAV we are getting 6 lakh and 6 lakh 90. Fine. From that, municipal tax paid during the year, reduce it. Then you will get net annual value. From that, 30% of standard deduction, please don't miss it, under section 24A. Then interest is under section 24B. Interest on money borrowed, both paid and unpaid. That is both on accrual system. I told you, both you can claim. Income from house property. From one house, they have loss, the other house, they have income. Clear? Sir, I have loss from one house property. Can I set it off against the income from another house property? Yes. But here that setting off and all they have not asked. So you can just stop it here, or else you can write one more line telling total income from house property will be net loss, guys. Net loss, which comes to like 15,450. 15,450. Correct? Now 65,000 loss. This is a loss figure. This is a loss figure. Clear? Yes. 350. 350. Not 450. 350. Okay, chill. We'll proceed further. This done. B is done. Next, C. C, guys. Geet and Jeet are two minor sons of Raghav and Riya. Okay, minor children's. Business income of Raghav is 3,40,000 and salary income computed of Riya. When it is already computed, you please don't do anything else. Don't even reduce standard. It is already taken care. 2,50,000. Income of Geet and Jeet from stage acting is 60,000 and 70,000 respectively. Guys, will it be clubbed? No. Why? If they are earning something out of their own efforts, performance, it will not be clubbed. So it will be taxable in the hands of children only. Next, whenever clubbing is getting attracted, in whose hand it will get attracted? Father or mother, whoever is having higher income. Here, if at all, if clubbing get attracted, it will be taxable in the hands of whom? Raghav, who is having higher income. Clear? Yes. Besides, interest on company deposits of Geet and Jeet. Deposit was made out income from acting. Okay, whatever they have earned, they have kept it as a deposit and they are earning some interest on it, which is 40,000 and 1,000 respectively. So that means Geet is earning 40,000 and Jeet is earning 1,000. Sir, will this income be clubbed? Yes. 40,000, 1,000 they are not earning from their efforts. Sir, what was the source of income to earn this? We are not caring about it. Clear? Yes, we discussed that 60, 70 will not be clubbed because that they earned out of their efforts. But this 40,000 and 1,000 interest what they are earning is not from their efforts. Now you need not worry about, sir, what about the source of income? They got it from their acting, no sir, or from their performance, no sir. You need not worry about that. If minor children are earning any income without their efforts, how the money came, from where they are earning and all, don't see. If they are earning without their efforts, then it will always be clubbed as per section 64(1)(a), guys. 64(1)(a). Next, Geet and Jeet have also received the following birthday gifts during the financial year 22-23. On 20th August 22, gift received by Jeet from his grandfather 75,000. Guys, is it taxable? No. For first check, see clubbing we will see later. First, is it taxable for Jeet? No sir. Why? Because section 56(2)(10), which talks about gift, excludes the gift received from relative. Grandfather obviously is a relative. Yes. So is this taxable? No. When it is not taxable in the hands of receiver, that is the minor child, there is no question of clubbing. Only if it is taxable for them, we will see, okay, it has to be clubbed or not. Next, on 14th November, Children's Day, gift received by Geet of rupees 60,000 from Riya's friend. Is this taxable? Yes. First check. Is it taxable for Geet? Yes. As per section 56(2)(10), the value of the gift is more than 50,000 received from non-relative on Children's Day. Exemption and all is not there. So is it taxable, sir? Yes. Now is it taxable in the hands of Geet? No. She is not getting gift out of her efforts and all. So in that case, will it be clubbed? Yes, it will be clubbed. Then 80,000 from Ria's sister. Who is Ria? Mother. So Ria's sister is she a relative? Yes. So will this be taxable? No. 56(2)(10) excludes gifts received from relative. So not taxable, hence no clubbing. Compute the total income of Raghav, Ria, Geet and Jeet for the assessment year 23-24, assuming that Raghav, Ria, Geet and Jeet does not opt to pay tax under section 115 BAC. Means they are following which scheme? Optional scheme. They are opting out of BAC and they are following optional scheme. Clear? Yes. Chalo. All the 4 people in one single calculation they are doing. Income from salary for Ria is given, computed. Please don't do anything else, guys. Don't even reduce standard deduction. Then income from business, which is already given for Raghav, 3,40,000. Guys, when parents both are having income, sir, with whose income the income of minors would be clubbed is whoever is having higher income. Whoever is having higher income. Okay. So if at all if clubbing get attracted, it will attract in whose hands? Raghav's hand. So income from other sources. Income from stage acting. So will it be clubbed? No, it is taxable in the hands of Geet and Jeet only because they have earned out of their own efforts. In this case, if at all, it is less than basic exemption limit, but still, if at all if they are liable to pay tax, then the parents will act as a guardian, guys, because they will not be having signing authority. So the parent will act as a guardian. Next, interest from a company deposit received by Geet. Will it be clubbed? Yes, but how much she received? 40,000. Whenever the income of minor child is clubbed, then the exemption also is available under section 1032, guys. How much, sir? The amount clubbed are 1,500 per child. Per month, 1,500 per child per annum. So 40,000 minus 1,500. How much would be clubbed? 38,500. I repeat, guys. Whenever the income of minor child is clubbed, as per which section? 64(1)(a). 64(1)(a). That parent in whose income it is clubbed, they will be eligible for an exemption under section 1032. How much, sir? The amount clubbed are 1,500, whichever is lower, guys. Here 1,500. Please be careful. Under default regime, this is not available. 1,500 exemption is not available. But here they have clearly told he is not following BAC. That means he is following optional, so hence eligible. Next, interest from company deposit received by Jeet to be clubbed in the hands of Raghav after exemption of 1,500 or the income to be clubbed. So how much is the income? Only 1,000 rupees. Only 1,000. Now you may tell, sir, 40,000 for one person, another person only 1,000. We don't know when they have kept the deposit, how much money they have kept and all. Whatever they have given interest is only 1,000. We will consider that. So 1,000 would be clubbed. Yes, sir. As per section 64(1)(a). Now Raghav can claim an exemption of how much? 1,000 rupees. Or 1,500, whichever is lower. So under 1032, how much exemption he can claim? 1,000. So what is the net amount which would be clubbed with the father? Nothing. Nothing. So you can see here, nil. Next, gift received by Jeet on 20th August 2022 from grandfather. Gift from a relative is not taxable. First check. For the receiver, is it taxable? First check that. If yes, then we will check clubbing part. Okay, when it is not at all taxable, you can also mention the section. As per which section? 56(2)(10). Gift received from relative is not taxable. Then gift received by Geet on 14th November from Ria's friend. Friend is not a relative, and moreover, sir, Children's Day, is it an exemption? No, only on the occasion of marriage exemption is there, not on birthday and all, or not even Children's Day also. Okay. So 60,000 is the amount. Is it more than 50,000? Yes. So will it be taxable in the hands of receiver? Who is the receiver? Geet. Is it taxable? Yes, sir. How much? 60,000. But now the question is, should she pay tax on it? No. Clubbing will get attracted. For whom? For father. Okay. Next, gift received by Geet on 14th November from Ria's sister is not taxable because she is a relative. Relative is an exemption given. All this clubbing will happen under which head, guys? Income from other sources. Now, sir, again, will we don't reduce 1,500 here, 1,000? No, already you have reduced. For Geet we have already reduced now here. So per minor child it is 1500 per year. Sir, here 2 times the incomes are clubbed, that is 40,000 as well as 60,000. So it is 1500 plus 1500. No, only once. Per minor child 1500 or the amount clubbed, whichever is lower. Clear? For each income clubbed you cannot claim exemption 1500. Okay. So income from other sources is this one, guys. Yeah, salary and business was anyway given. The main target here is the clubbing part, guys. Clubbing part. That's all. Yes, we are done with. Compute the total income is what they have asked. It's better you total up also. Okay. They have just stopped it here. It's better you total up all these three. You can just give a notation like A plus B and here's income from other sources C. You can show A plus B plus C, assuming there is no deductions and all, because question is silent about any deductions. So assume that assessee is not eligible to claim any deductions, guys. That's all. Okay, chalo, let us move towards next question. Nisha, a resident individual, provides the following details of her income or losses for the year ended 31st March 2023. Long-term capital gain on the sale of equity shares computed in accordance with section 112A, 9,95,000, which is taxable at 10% in excess of 1 lakh. Yes, I'm just mentioning it. We will see what is the requirement of the question. Interest on FD gross 73,000. That means gross means before TDS. Loss from sugar business. Loss, please be careful. 8,70,000. Sugar is normal. Only there are two special businesses for adjusting loss. Which are those? Specified and speculation. Then speculation profit. So, sir, can I adjust my other business loss against speculation business profit? Yes, you can adjust, but vice versa is not possible. Lottery income net of TDS. Net of TDS. Under which section TDS would be deducted on lottery income? 194B. What rate? 30%. So, we have to do grossing. Grossing. Then loss incurred by the firm in which she is a partner. Loss incurred by a firm in which she is a partner. Okay. Salary received as a partner from partnership firm. The same was allowed to the firm. So whatever is allowed to the firm as per section 40B, same thing will be taxable in the hands of partner under the head PGBP. So here they have told it is allowed for the firm. That means it is taxable for the partner under the head PGBP. Next, brought forward short-term capital loss on sale of gold. Gold, guys, please be careful. Only if it is EFT, it is covered under section 111A. If it is any other asset, we will consider it as normal income. Clear? Because if it is short-term capital gain, only if it is on the transfer of EFT, that is equity shares, equity oriented fund or units of business trust, only then it is special. Any other short-term capital gain, normal. Okay. Brought forward loss on sale of equity shares of the nature specified under section 111A, which is taxable at 15%, entire amount. Okay. What is the requirement of the question? Compute the gross total income of Nisha for assessment year 23-24 and the amount of loss that can be carried forward, assuming that she does not opt to pay taxes under section 115 BAC. So does not opt means she is following what? Optional scheme, guys. That is regular provisions of the Act. First, PGBP. She doesn't have any income under the head salary and house property. So first one is PGBP. Salary received from firm. Please be careful, as there is no employer-employee relationship. It is taxable under the head PGBP. Now, sir, what about the loss? Guys, we know that share of profit received by a partner from partnership firm is exempt in the hands of partner. Yes, sir. Now, if a partnership firm has a loss, can partner claim it? No. When you have an income which is share of profit, which is exempt in the hands of partner, if there is a loss, you cannot enjoy the benefit. Partnership firm can claim that loss. They can adjust it against other incomes, but not the partner. Next, speculation profit 2,40,000 is there. So the total income under that PGBP is coming to 3 lakh. Then we have a loss from sugar business, which is 8,70,000. But here we cannot adjust everything because we have only 3 lakh income. So you are adjusting only 3 lakh loss here. Sir, what about the remaining 5,70,000 loss? I can adjust as it is a current year business loss. We can adjust it against other rates also, but except salary. And even against casual income, you cannot adjust any loss, guys. You cannot adjust any loss. So remaining 5,70,000 we will set it off against the capital gains income or income from other sources, which is not casual, Okay, now coming to capital gains. Long-term capital gain on the sale of equity shares computed as per section 112A, 9,95,000. Loss from sugar business, current year loss is to be given priority. So we are taking that first, 497. Then brought forward short-term capital loss we have, can we adjust? See, short-term loss can be adjusted against either long-term gain or short-term gain. But long-term loss can be adjusted only against long-term gain. Then brought forward loss on sale of equity shares of the nature specified under section 111A, 25,000. And please be careful guys, for the purpose of adjusting the loss, whether the short term is special income or normal income doesn't matter. Only for tax rates purpose it is important. Okay. So after adjusting all this, how much is left? Capital gains income 2,43,000. Then coming to other sources, interest from FD 73,000. Sir, can I adjust loss against it? Yes. Actually what they have done is, after adjusting against business income, how much was left? 570. In that 570, 73 they have adjusted here and remaining they have adjusted here guys. Clear? So what I can suggest you is straight away do full 570 here only. You can do full straight away 570 here only. Or else whatever they have done also is correct only. But instead of doing it in two steps, better you can straight away take full 570 here. Okay. But sir, whatever they have done is also correct? Yes, it is correct. Because against interest, you can claim the loss. And it is a current year business loss. You can do it. But sir, can they adjust it against winning from lottery? No, no. Against casual income, you cannot adjust any loss. And lottery income is given it as net guys. That is before, after TDS. So please be careful. As TDS rate, we discussed 30%. So you do 75,000 is the net amount received divided by 100% minus TDS rate, how much? 30%, which comes to 70%. So how much is that? 1,07,143. And the gross total income is 3,50,143. They have asked only gross, please stop it there. And should I round off the gross total income figure? No, it is total income figure. Clear? And in the question they have asked only gross total, please stop it there only guys. Please stop it there. Okay, next coming to sub question B. Just a minute. Yeah, sub question B guys. SM Services, a partnership firm, consists of two working partners, Sunil and Murthy, with 60 and 40% share. That is their profit sharing ratio respectively. As per the partnership deed, they are eligible for interest and capital at 15% per annum. But can they claim full? No. As per the deed, whatever is there, or maximum 12%. So how much maximum interest the partnership firm can claim as per section 40B? 12%. On their capital contribution of 18 lakh each and remuneration of 55,000 per month to Sunil and 45,000 per month to Murthy. Guys, interest as well as remuneration is subject to 40B limit for a firm. And whatever is allowed to the firm will be taxable in the hands of partner under the head PGB. The firm is engaged in manufacturing business. During the year ended 31st March 2023, the net profit as per profit and loss account was 25,36,000, which they have already given. But before considering interest on capital and remuneration to the partner as well as the following items, means whatever profit they have given is before interest, before remuneration and before the following items. That means we have to take care of all this. Current year revenue expenditure on scientific research, can they claim it? Yes, 35 full deduction. Then brought forward business loss of assessment year 18-19, can they adjust it? Yes, but if it is a brought forward, you can adjust it only against business income. Same head. Then brought forward business loss assessment year 14-15. Now this is relating to 14-15. Now we are in assessment year 23-24. We have to check whether 8-year period is still there or not. If 8-year period is already over, then you cannot adjust the loss. Then unobserved depreciation relating to assessment year 11-12. Unobserved depreciation you can carry to any number of years guys. It has unlimited life. Okay, next. Unobserved capital expenditure on scientific research relating to previous year 19-20. Can we claim it? Yes, actually for capital expenditure on scientific research, you have a benefit of carry forwarding also. Same like unobserved depreciation, which we already discussed in our regular class guys. So can we claim this, sir? Yes, we can claim. Next, current year capital expenditure on scientific research, can we claim it as? Yes, except land. When they have not given anything like on what they have spent, assume it is not on land. If it is on land, you cannot claim. Current year depreciation under section 32. Oh, all the capital things they have given more. You are required to compute the total income of SM services for the assessment year 23-24 after considering the above items. So please be careful, guys. Whatever profit they have given is before interest, before remuneration, and before the following items. Means adjusting the loss, unobserved depreciation, even current year depreciation is there. Even current year depreciation is not yet claimed. And that is as per section 32 means can they claim? Obviously they can claim. Chalo. We should know what we should adjust, how much we can adjust. That's all here, nothing else much. And 40B also is there, which we have to take. Net profit, whatever they have given, we are taking it as a base. Then expenditure or loss, which we can adjust, guys. First, interest they can claim, but only up to 12%. They are paying 15, but firm can claim how much maximum as per 40B? 12%. So 12% per annum being a maximum allowed on the capital, guys. So on 18 lakh, 12% for two partners, because each of them I guess have contributed 18 lakh. 18 lakh each. 18 lakh each. Profit sharing ratio is different, but the capital what they have contributed is same, guys. Please be careful. So 18 lakh into 12% on that is for two partners. Next, current year revenue expenditure on scientific research they can claim, current year depreciation they can claim, current year capital expenditure, first all current years. Then unobserved depreciation can they claim? Yes, we can carry forward for any number of years. 8-year period and all is not applicable for unobserved depreciation. Please be careful. Then unobserved capital expenditure, can we claim it, sir? Yes, you can claim. First always current year, guys. Then you will come to brought forward or unobserved. So, sir, what about this loss, sir? Something related loss. Business losses also is there, which we will see later. That is, we will adjust at this stage. Business losses. Because, see, sir, what about this too, sir? Because these are related to PGBP8 only. First, you can claim. You can claim this before calculating book profit. Please be careful with it. Oh. So, how much is the book profit? 9,54,000. Based on this, we will calculate permissible remuneration, guys. Book profit. Permissible remuneration to the partner as per limit prescribed on the first 3 lakh 90%. On the remaining, that is 9,54,000 minus 3 lakh, you will get how much? 6,54,000. On that 60%. So add up both. What is the limit as per section 40B? 6,62,400. But actually, what is the remuneration paid? 55,000 into 12. That is for one partner. For another partner, 45,000 into 12. Total remuneration you take. Don't take individually. Total. 12 lakh. Compare both. Take whichever is lower. So what is the permissible remuneration? 6,62,400. Can they claim it? Yes. So from book profit we have to reduce it. We will get, so from book profit 9,54,000 we have to reduce 6,62,400. We get what is the profit from their business, current year profit. Sir, can they adjust brought forward loss? Yes. So brought forward loss of assessment year 14-15 is still 8 years over? No, not yet over. So that means, sorry, 14-15 over. Okay. Whereas 18-19. First we will discuss 18-19. For 18-19, still 8-year period is not over, sir. Not over. So can they claim it? Yes. Whereas for 14-15, 8-year period is already over. So can we adjust that? No, you cannot adjust. So after adjusting the brought forward loss, what is the profit of the business? 2,59,600. Clear up. Please be careful with that 8-year period also. Whenever they are giving brought forward loss, check which year it relates to and which is the current year. Is 8-year period over? Check it. Means you have to add 8 years and check it. And while counting the years, leave the year in which loss is suffered. You have to take next 8 years. You have to take next 8 years, guys. So in simple. So if you take, sir, loss is relating to 14-15. Leave 14-15 plus 8 years. So it would be like 22-23. Maximum you can carry forward up to which year? 22-23. But now we are in which assessment year? 23-24 as per the question. That means can we adjust the loss? No. 8-year period is already over. Thank you. Chalo, last sub question here. Rajendra, aged 47 years, a resident individual engaged in retail business of stationery products, furnishes the following particulars of his income for the previous year 22-23. Income from business 15 lakh 10,000. LIC premium paid for dependent father aged 75 years. Guys, LIC premium paid can be claimed as deduction under section ATC only for the insurance policy taken in the name of assessee or his children or spouse, not for the parents. For parents, deduction is not allowed. For parents, the premium allowed is health insurance premium, not life insurance premium under section ATD. Please be careful. So ATC will not give deductions for the life insurance premium paid on the life of the parents, guys. They have given the life for you. For them only you are taking insurance, is the kind of provision they have covered here. So that means no deduction, guys. Okay. Interest received from public provident fund. Interest received. Actually, it will be keep on credited to the account. You will not get it, but still. Sir, is interest taxable? No, it is exempt. Then interest from bank on savings bank deposit taxable under other sources. Then deposit into PPF, you can claim deduction under section ATC. You are required to calculate his tax liability, not income, tax liability, and advise him whether he should opt for alternate tax regime under section 115 BSE or not. Means we have to calculate tax liability under both the schemes and tell him which is beneficial. So it is more like a suggestion, recommendation, guys. Chalo. So income from business, that is PGBP, 15 lakh 10,000. Then income from other sources, interest on PPF not taxable, guys. It is completely exempt. Interest from bank on savings bank account, please be careful. First you include it there, later you can claim deduction also for this. Then gross total income you will get. Okay. Then deduction under section ATC for deposit in PPF you can claim. Then what about the LIC premium? I already explained it. LIC premium paid for a dependent father, premium for life insurance policy of father is not allowed as deduction. Since the maximum deduction under section ATC is 1,50,000, so 130 is allowed. Full 130 you can claim. For father, whatever life insurance premium you are paying, you cannot claim it. Then ATTTA, sir, interest is on savings bank deposit. Can I claim deduction under section ATTTA? Yes. How much? Maximum 10,000. Maximum 10,000. Sir, is assessee eligible for TTB deduction? No, he is not senior citizen. He is still, I guess, 47 years. What is his age? 47 years. So he is not a senior citizen. So he is not eligible for TTB deduction, guys. So what is the total income under the optional regime? Under optional regime, what is the, better always write, total taxable income under the optional regime, 13 lakh. Optional scheme or optional regime, 13 lakh 92,000. On that tax, up to 2 lakh 50,000 nil, basic exemption limit. Then 2 lakh 50 to 5 lakh 5%, which comes to 12,500. Then 5 lakh to 10 lakh 20%, which comes to 1 lakh. Then 10 lakh to 13 lakh 92,000 30%, which comes to 1 lakh 17,600, guys. So gross tax, it's better you write it in next line, mentioning it as gross tax liability. Assessee is not eligible for rebate. Why? Total income is more than 5 lakh. Yes, sir. Then surcharge is applicable. No. Total income is within 50 lakh. Then straight away add health and education cess. 4%. 4% on what? Gross tax. So under the optional regime, what is this tax? 2,39,304, which can be rounded up to nearest to 10, which is 300. As per section 288B, guys. This is optional regime. Now under default regime, under 115 BAC, which is nothing but default scheme or default regime. Guys, under default regime, can he claim chapter 6A deduction? No, sir, he cannot claim. So straight away his gross total income will become what? The total income under default regime, because he cannot claim chapter 6A deductions here, all this. Yeah. Gross total income as per regular provisions of the Income Tax Act 1961 is 15,32,000, and no deduction under chapter 6A is allowed. Few are allowed, guys. Under default regime, few are allowed, like CCD subsection 2, CCS subsection 2 and all. But here, assessee, whatever is claiming, ATC or ATTTA, can he claim that deduction under default regime? He cannot. Okay. So total income as per the section 115 BAC default regime is 15,32,000. On that we have to compute tax. Guys, please be careful. Now as per Finance Act, the tax rates have been changed. As per the default regime, it is not 2,50,000 basic exemption limit, it is 3 lakh. Let us calculate. Okay, now up to 3 lakh nil. Then 3 lakh, more than 3 lakh to 6 lakh, it is 5%. Amount comes to 15,000. Then more than 6 lakh to 9 lakh, 10%. Amount come to 30,000. Hope you guys are understanding the calculation. The difference, that is the difference between the upper limit and lower limit. 9 lakh minus 6 lakh, how much you get? 3 lakh on that 10%. Then more than 9 lakh to 12 lakh, 15%, which comes to 45,000. Then more than 12 lakh to 15 lakh, 20%, which comes to 60,000. Then more than 15 lakh, it is 30%. 25% slab is not there. For every 3 lakh increase in the income, tax rate will increase by 5%, but 25% rate is not there. Over and above 15 lakh, it is always 30%, guys. Okay, so 1532. So here we have to calculate. So 32,000 into 30%. Correct. So 32,000 into 30% will give you 9,600. Add up everything. That is your gross tax. So let me add it. 1,59,600 is your gross tax liability. Plus, sir, is rebate available? No. Total income is more than 7 lakh. No rebate. Under default regime, the limit for rebate is 7 lakh, guys. Okay. Is surcharge applicable, sir? No. Total income is not more than 50 lakh. So straight away, health and education says, sir, 4%. So if I had 4%, straight away I am calculating the amount 1,65,984, which I will round it up to nearest to 10 rupees, 980, guys. 980. That is final tax liability under the default regime. Under the default regime. So which is beneficial? 165,980 or 2,39,300. Sir, default is better, sir. Default is better. Why? Because the tax liability is lower. Because the tax liability is lower. Whenever the question is like this, you please give the suggestion or recommendation telling wherever the tax liability is lower, that is more beneficial. Clear? Huh? Yes. So please be careful with this calculation, guys, because the tax rates now has been changed. We're done with all the sub questions here. Yes, sir. Sure. 3 is done. Next, guys, still question number 3. All the questions are like mandatory. Whereas in 4, you have a choice. You can choose 4 or 4A. Means once you choose 4, you have to answer all sub questions. Or if you choose 4A, answer all sub questions. Either 4 or 4A. Okay. So that means question number 1, 2 and 3 is like a mandatory for you. Okay. Chalo, let us see. 4A. Under 4, the sub question A. Explain the term return of loss under the Income Tax Act 1961. Can any loss be carried forward even if return of loss has not been filed as required under section 139 subsection 3 of the Income Tax Act 1961? Guys, whenever the assessee has a loss, if he cannot adjust it in the current year, he can carry forward it. Few loss for 4 years, few loss for 8 years and few loss for unlimited period, he can carry forward. Provided he is filing the loss returns within the due date. Within the due date given where? Under section 139 subsection 1. It can be 31st October, it can be 31st July or it can be 30th November depending upon who am I. Clear? Huh? What is the due date to file returns, guys? Come on. If tax audit is applicable for me, then 31st October of the assessment year. If I am supposed to furnish transfer pricing report where I am engaged in international transactions and all, it is 30th November. If not, always 31st July of the assessment year. Clear? Huh? So even the return loss has to be filed within this due date. Whatever is applicable for me. If I don't file, I cannot carry forward my losses, even though I have a loss. But there are 2 exceptions. That is, house property loss and unobserved depreciation can be carried forward, even though if loss return is not filed. Even though if not, a loss return is not filed. Let us see what answer they have given. A return of loss is a return which shows certain losses under income tax under various heads of income. Section 80 of Income Tax Act 1961 provides that The losses specified therein cannot be carried forward unless such losses are determined in the pursuance of return filed under the provisions of section 139 subsection 3. Section 139 subsection 3 talks about loss returns, guys, of the Income Tax Act. Section 139 subsection 3 of the Income Tax Act 1961 states that to carry forward the losses specified therein, the return should be filed within the specified date, that is the due date given under section 139 subsection 1 only, whatever I just now discussed. Following losses are covered by section 139 subsection 3 of the Income Tax Act. That means the following losses can be carried forward only if you file loss returns. Which are those? Business loss to be carried forward under section 72 subsection 1, speculation business loss, then loss from specified business, loss under the head capital gains, loss incurred in the activity of owning and maintaining resources, guys. Sir, what about house property? I told you house property and unobserved depreciation you can carry forward even if loss return is not filed. However, loss from house property to be carried forward under section 71B and unobserved depreciation under section 32 can be carried forward even if return of loss has not been filed as required under section 139 subsection 3 of the Income Tax Act 1961. Fine? Sure. We'll proceed further. Simplest. So this and all is a theory question, pure theory. Income deemed to accrue or arise in India to a non-resident. So the person who has earned the income is non-resident by way of interest, royalty or fee for technical services to be taxed irrespective of the territorial nexus. Correct now? Yes. Examine the correctness or otherwise of the statement with reference to the provisions of the Income Tax Act 1961. So the person in the question is non-resident. He has earned the income by way of what? Interest, royalty or fee. Is it taxable in India? Depends on whether the services or money is it used in India or for any business in India or to earn any income from the source. We have to check. Means for what purpose the service or the money is used is important. Clear, guys? Yes. Let us go through the answer. The statement is correct. As per the explanation to section 9 of the Income Tax Act 1961, income by way of interest, royalty or fee for technical services, which is deemed to accrue or arise in India by virtue of clauses 5, 6 and 7, which talks about income deemed to accrue or arise in India, guys, of section 9 subsection 1 of the Income Tax Act, shall be included in the total income of a non-resident whether or not non-resident has a residence or place of business or business connection in India, or non-resident has rendered any services in India. Where services is rendered, where the money is lent is not important, where it is utilized is important. In effect, the income by way of fees for technical services, interest or royalty from the services utilized in India or money invested in India or used in India would be deemed to accrue or arise in India in case of non-resident and will be included in his total income, whether or not such services were rendered in India and irrespective of whether the non-resident has a residence or place of business or business connection in India, guys. All this will not matter. Where the services or money is utilized, that is important. Yes. Next, last sub question here. Each sub question is for 5 marks each, guys. Deepak furnished his return of income for the assessment year 23-24 on 22nd July 2023. Due to missing information for payment of tax in the return of income, the assessing officer considered it defective return under section 139 subsection 1 of the Income Tax Act 1961. What are the consequences if defect is not rectified within the time allowed? It is as if the person has not filed the return only. Correct now? That is the consequence. Then specify the remedies available if defect not rectified within the time allowed by the assessing officer, guys. So fourth question is completely theoretical question. Full 15 marks. If the defect is not rectified within a period of 15 days or such further extended period, then the return would be treated as invalid return, and the further it shall be deemed that the assessee had failed to furnish the return of the income, means as if the assessee has not at all filed the return. In that case, he will be liable to pay what? Late fee along with interest. Accordingly, the consequential effect would be the same as if the assessee had failed to furnish the return of income, guys, as if he has not filed the returns. The assessing officer has the power to condone the delay and treat the return as a valid return. If the assessee has rectified the return after the expiry of 15 days or further extended period, but before the assessment is made. Clear? Means the assessing officer has the power to condone the delay and tell, okay, even if it is after 15 days, you can still file your return or rectify your return. So 4 is done. The last part, 4a. 4a, first sub question here. Examine the applicability of tax deduction at source, that is TDS, guys. This question is exclusively on TDS. The rate and amount of TDS, both they are asking, rate as well as the amount of TDS. So obviously you have to mention that section also. In the independent following cases for the assessment year 23-24 under the Income Tax Act, assume that all the payments are made to residents. So that means who is the payee? Resident. In all the cases, the resident is the payee. Okay. And guys, they are told all these cases, totally 5 cases are there and they are independent of each other. There is no connection from one point to another point. Let us see one by one. Payment made by a company to Shanti Lal, subcontractor. So Shanti Lal is a subcontractor, so contract payment it is 3,50,000 with an outstanding balance of 1,50,000. So 350 is paid plus outstanding balance of 150 shown in the books as on 31st March 2023. Okay, paid 350, outstanding is 150. So TDS has to be deducted on what? Amount. What? So we have a time of deducting TDS at the time of credit or payment, whichever is earlier. So even if you have made payment, you have to deduct it. Sir, I was supposed to pay. I have given credit, but not yet paid. On that also, I am supposed to deduct TDS. Sir? Yes. Provisions of tax deduction at source under section 194C, contract payment, are attracted in respect of payment by a company to a subcontractor under section 194C. Tax is deductible at the time of credit or payment. Even if you are not paid, if you are liable to pay, are you supposed to deduct TDS? So in that case, sir, I have not yet made the payment only, sir. How will I deduct TDS? You are supposed to deduct. So if you are not able to, at least give it from your pocket. And when you are actually making the payment, you can deduct and keep in your pocket. Clear? So the deduction responsibility is on the head of payer. If he has not yet made the payment, but entry is passed in his books, in that case, he can pay the TDS amount out of his pocket to the government, and later when he is actually making the payment, he can deduct it and keep it in his pocket. So what is the rate? Whichever is earlier, at 1% in case the payment is made to individual. So who is the payee here? Individual. So what is the rate of TDS? 1%. Sir, what if it is any other person? Then 2%. If payee is individual HU of 1%, any other person 2%. Please be careful. Payer is a company, whereas payee, the contractor, subcontractor is an individual. So 1%. Since the aggregate amount credited or paid during the year is 5 lakh, that is 350 plus 150. Hence, the tax is deductible at 1% of 5 lakh, which comes to 5,000. Clear? You can observe. This is what they have clearly asked. Rate and amount. If you want, you can also add one column for section. Section, rate, amount. Okay. First case done. B. Fee paid on 1st January 2023 to Dr. Banavat by Kishan HF 40,000 for surgery performed on member of the family. So the payer is HF, guys. Kishan. Who is the recipient? Individual. Payee is an individual, whereas the payer is a HF. For what purpose? Surgery performed on member of a family. So it is for personal purpose. Personal purpose, guys. As per the provisions of section 194J, because when you are making the payment to doctor, is it a professional payment? Yes, professional fee. A Hindu undivided family, that is HUF, is required to deduct tax at source on fees paid for professional services only if the total sales, gross receipts or turnover form of the business or profession, as the case may be, in the financial year preceding the current financial year exceeds, and such payment made for professional services is not exclusively for personal purpose of any member of HUF. So simple, what they are telling is, when HUF is the payer, we have to check whether in the last year they were subject to tax audit. Yes, if they are subject to tax audit, in the current year they should straight away deduct TDS. No. If it is for their personal purpose, they should not deduct the TDS. If it is for any other purpose, they are supposed to deduct TDS, guys. And whenever TDS is not applicable under section 194J, we should also check 194M. Provides for deduction of tax at source by an HUF, which is not required to deduct tax at source under section 194J in respect of fee for professional service if such sum or aggregate of such sum exceeds 50 lakh during the financial year. Guys, simple. 194J covers only individual or HUF who are subject to tax audit last year. So whoever is not covered in 194J can be covered in M. Provided, even though they are not subject to tax audit, they are covered under M. But whatever amount they are paying in a year is more than 50 lakh. Clear? Yes. So actually M is trying to cover the payer whoever is not covered in 194C, 194H and 194J. That is the individuals or HUF who was not subject to tax audit last year. They would have not been covered under CHJ, 194 CHJ. So they are trying to cover them where? In M. Only if they are paying more than 50 lakh in a year for any of this. In the given case, the fee for professional service of Dr. Banawat, who is a payee, is paid on 1st January for a personal purpose. That is the key here. Therefore, section 194J is not attracted. Next, coming to M. 194M would have been attracted if the payment or aggregate of payment exceeded 50 lakh in the year, but it is not more than 50 lakh. So even 194M will not get attracted. So that means TDS is nil, guys. TDS is nil. There is no TDS. Simple. Yeah. Next. Danpal wishes to purchase a residential house costing 60 lakh from Priya. The house is situated at Mumbai. Both the buyers as well as the sellers are residents in India. So in case of buying the immobile property, so the buyer, if he is paying more than 50 lakh, should he deduct TDS? Yes, under section 194 IA. At what rate, sir? 1%. Actually, we should compare actual purchase price with stamp duty value. We have to take whichever is higher and check is it more than 50 lakh. If yes, we have to deduct TDS at 1%. But here in this question, they have not given the stamp duty value. They have given actual purchase value, which is more than 50 lakh. Should TDS be deducted? Yes, at 1%, as it is more than 50 lakh. Yeah. As per section 194 IA, any person being a transferee, that is a buyer, guys, responsible for paying to a resident, who is this? Seller. Transfer or any sum by way of consideration for transfer of any immobile property, that is any land other than rural agriculture land. If it is a rural agriculture land, then TDS is not applicable. Even though sale value is more than 50 lakhs, still TDS won't be applicable. Okay. Or any building or part of the building shall be liable to deduct tax at source at 1%, where the total amount of consideration for the transfer of immobile property is not less than 50 lakh or more than 50 lakh. Since the sale consideration of the house property exceeds 50 lakh, Danpal is required to deduct tax at source under section 194 IA. The tax to be deducted under section 194 IA, immobile property, easy to remember, 194 IA, immobile property, yes, would be 60,000 being 1% of 60 lakh. Guys, when it is more than 50 lakh on the entire consideration, 1%. Actually, I told you, actual purchase value or stamp duty value, we have to compare it. Take whichever is higher, check whether it is more than 50 lakh. If yes, deduct 1% on whichever is higher. Deduct 1% on whichever is higher. But in this question, stamp duty value is not given. Ignore it. On whatever purchase value, as it is more than 50 lakh, deduct 1% TDS. Next, fourth one. Arun has paid 5 lakh on 12th October to Cold Storage Private Limited for preservation of fruits and vegetables. He is engaged in the wholesale business of fruits and vegetables in India, having turnover of 4 crore during the previous year. Means they are trying to tell that he is subject to tax audit. Okay. Because 4 crore means obviously you know that they are subject to tax audit, guys. Yeah. D. The arrangement between Arun, the customer, and Cold Storage Private Limited, the cold storage owner, is basically contractual in nature. And the main object of the cold storage is to preserve perishable goods by mechanical process, and storage of such goods is only incidental. Okay. Hence, the provisions of section 194C will be applicable to the amount of 5 lakh paid by Arun to the cold storage company. Accordingly, tax has to be deducted at 2% here. Why, sir? The payee is a company, not individual or HUF. Please be careful. So, on 5 lakh, 2% comes to 10,000. 10,000, guys. Okay. Next. Last one. Last sub question. Ravi, a salaried individual, has paid a rent of 65,000 per month to Rajiv from 1st August to 31st March. Okay, an individual is paying a rent of 65,000, more than 50. Rajiv has not furnished his permanent account number as they have clearly mentioned as salaried individual. Guys, sir, is 194I applicable? No, because they are not subject to tax audit last year, because salaried employed and all will not get their books of accounts audited. Okay, so that means I is not applicable, means no TDS. No, as the monthly rent is more than 50,000, TDS is applicable. Let us see. Ravi, being a salaried individual, has to deduct tax at source at 5% under section 194 IB, not IB, on the annual rent paid by him from the last month's rent, that is the last month of the previous year. Rent of March. Since the rent paid by him exceeds 50,000 per month. Per month, if he is paying more than 50,000, then he is not covered under section 194I, but he is covered under IB. Since his landlord, Mr. Rajiv, has not furnished his PAN. Have they given that also? Rajiv has not furnished his PAN. Yes, they have given it. So if PAN is not given by the payee, then what rate TDS would be deducted, guys? 20%. Actual rate is 5%, but if payee has not given his PAN, then 20%. Yes, sir. However, the same cannot exceed 65,000, because what is the monthly rent? 65,000. So the amount of TDS cannot exceed 65, because in IB they are clearly asking you to deduct TDS at the end of the year, that is the last month of the previous year. So when you are paying 65,000, maximum TDS you can deduct is 65,000. Okay. So TDS under section 194 IB, which is 65,000 into 8 on that 20%. Okay, only 8, sir. Yes, because he started from August to March. Clear? He's continuing even after March, but for the previous year, we will consider only till March. Clear? April, May, June, July, he didn't stay in a rented house, guys. So we are taking only 8 months. So on that 20%, which comes to 1,04,000. Can he deduct 1,04,000? No, sir, because he's paying only rent of 65,000. So it is restricted to 65. Even though the amount deductible is 1,04,000, it has to be deducted how much? 65. Means he will not pay any rent in the month of March. Entire amount he will deposit as TDS to the government, guys. Clear? So mention accordingly 65. But clearly mention 1,04,000, but restricted to 65. Fine, guys. That is done. Bit lengthy question. Actually, this will take for 5 marks. What they have asked is too much. This will take too much time for a student to present. Better try to attend this kind of questions at the end, or if not, take it as an option. Better attend 4 instead of 4 here, because even though you know these questions, this kind of questions will take more time to present it, guys. Okay, let me proceed further. Ajay, a property dealer, entered into an agreement with Mukesh to sell a plot. Guys, what would be plot for him? Stock. When is it? Dealer. Okay. Entered into an agreement on 6th April, guys, for 55 lakh. So sale value is 655. He received an advance of 12 lakh from him on the date of agreement by an account payee check. Transfer took place on 12th September. So agreement date is 6th April. Date of registration or transfer is 12th. The valuation determined by the stamp valuation authority on the date of agreement and date of transfer was 59 lakh and 63 lakh respectively. Mukesh has sold this plot to Deepthi on 24th March 2023. That is further sale for 65 lakh. So Mukesh is actually purchaser. After purchasing it, he is selling it to Deepthi in March 2023 for 65 lakh. The valuation as per stamp valuation authority was 64 lakh on 24th March. Discuss the tax consequences of above in the hands of Ajay and Mukesh Also compute the capital gains in the hands of Mukesh. That is when he further sell it to Deepthi, guys. Note, none of the parties, that is Ajay, Mukesh and Deepthi, are related to each other. The transactions are between outsiders. Okay, guys, what is the transaction here? See, for the seller, we have to check first. Who is the seller? Ajay. For Ajay, the plot what he is selling is a stock, guys. So we have to check section 43 CA. 43 CA, which tells we have to compare the actual sale value with stamp duty value. Stamp duty value on what date, sir? Either date of agreement or date of transfer. So here, what are we supposed to take? The condition is like this, guys. Stamp duty value on the date of agreement can be taken at least if part of the consideration is received on or before that in any mode other than cash. Means on or before the date of agreement, the seller should have received at least a part of the consideration in any mode other than cash. In the given case, have you received it? Yes, he has received 12 lakh on the date of agreement through account payee check. So that means we will consider the stamp duty value on what day? Date of agreement, which is 59 lakh. Which is 59 lakh. Actual sale value is how much, guys? 55 lakh. Actual sale value. So stamp duty value, we have to take 59 lakh. Clear? So what we have to do is not straight away compare both. We have to take 110% of actual sale value. 100, because up to 10% difference is allowed. So 110% of 55 lakh comes to 60 lakh 50,000. 60.5 lakh. Yes, sir. So stamp duty value is how much? 59 lakh. That means this is more than 59 lakh. Yes. So the difference is within 10%, sir. Yes. So they are telling for the purpose of computing PGBP income, what is your sale value? 55 lakh only. As the difference is within 10%, they are telling we need not consider stamp duty value. Ignore stamp duty value. Ignore the stamp duty value. So for Ajay, to compute PGBP income, what is his sale value? 55 lakh, guys. Same way, for the buyer Mukesh, if he has purchased the immobile property for inadequate consideration, 56 to 10 will get attracted. Yes. So there also they have told first check inadequate consideration. That is from buyer point of view, guys. We are applying 56 to 10. They are not related to each other. That means 56 to 10 can be applicable. So first check inadequate consideration. So how much is the stamp duty value? 59 lakh. So 59 lakh minus 55, 4 lakh is the inadequate consideration. Check, is it more than higher of the two things? Higher of two things. What is it, sir? 50,000 or 10% of actual sale consideration, 55 lakh, which comes to 5 lakh 50,000. 5 lakh 50,000. Whichever is higher is how much? 5 lakh 50,000. So is this inadequate consideration more than 5 lakh 50,000? No, sir. In that case, is inadequate consideration taxable? No, it is not taxable in the hands of recipient. Clear? We have to check like this, guys. Means indirectly they are telling up to 10% difference. If it is there, fine. If the difference is more than 10%, then we are charging the difference. Clear? Even here, if more than 10% difference is there, then to compute the PGBP income of the seller, we will take what? Stamp duty value and not actual sale value. Here also, if by chance if the difference is more than 10%, inadequate consideration would be taxable in the hands of Mukesh, guys. Clear? But here, will it be taxable? No. As the inadequate consideration is within 10%, nothing is taxable. Then Mukesh has sold the property. That would be short term because he has held for less than 24 months. He has sold it to Deepthi. So we have to compute short term capital gain, guys. Fine. We'll just go through it quickly. I have explained whatever is there. The provisions. As per section 50C, okay, of the Income Tax Act 1961, where the actual sale consideration is less than the value adopted by Stamp Valuation Authority for the purpose of charging stamp duty, the stamp duty value exceeds 110% of the actual sale consideration, then the value adopted by Stamp Valuation Authority shall be taken to be as full value of consideration. And please be careful, 50C is a part of capital gains. In case where the date of agreement is different from the date of registration, stamp duty value on the date of agreement can be considered, provided the whole or part of the consideration at least is received by way of account pay check, bank draft, or by way of electronic clearing system through bank account or through such other electronic mode like debit card, credit card, UPI and all. In simple, you should not receive in cash, guys. That's as may be prescribed on or before the date of agreement. In this case, since 12 lakh is received through account pay check on the date of agreement, stamp duty value on the date of agreement would be considered for determining the full value of consideration. Accordingly, in this case, business income would be computed in the hands of Ajay for assessment year 23-24, taking the actual consideration of 55 lakh, that is actual sale value of the plot, as the full value of the consideration arising on transfer of such plot, since the stamp duty value on the date of agreement does not exceed 110% of actual consideration. And this is as per section 43CA. Actually, they have started from 50C. Guys, 50C and 43CA has same provision, but 50C is when the land and building is a capital asset for you, whereas 43CA is applicable when land or building is a stock for you or inventory for you. In the question, it was inventory for Ajay. So it's better you mention 43CA. Provision is same, but the section and head will change. Yeah, at the end they have told 43CA anta, but it's better you explain it as per section 43CA, same provision, same to same provision. And it is under PGBP, guys. Even in my regular classes, we have covered this together because same provisions but two different head. Okay, I have explained through chart and all. First, see, land or building, is it a capital asset or stock? Accordingly, apply the respective section. Now, in the hands of Mukesh, will section 56 to 10 get attracted? No, sir. In case immobile property is received for inadequate consideration, the difference between the stamp duty value and actual consideration would be taxable under the head income from other sources under section 56 to 10. In the hands of recipient, that is Mukesh here, that is the buyer. If such difference exceeds a year of 50,000 or 10% of actual sale consideration. Actual sale consideration or purchase value is one and the same, guys. Don't get confused. Because from purchaser point of view, we call it as purchase value. Even if you call sale value, nothing different, which is nothing but for seller. In a case where the date of agreement is different, that is the story is same, guys. So in this case, since 12 lakh is paid through account pay check on the date of agreement, stamp duty value on the date of agreement would be considered. Whenever the date of agreement and registration is different, check the date of agreement. Check is anything received on or before that date in any mode other than cash. If yes, we will take stamp duty value on the date of agreement. If not, we will take stamp duty value on the date of registration, which will change the answer entirely. Please be careful. Therefore, nothing would be taxable in the hands of Mukesh under the head income from other sources in assessment year 23-24, since the difference between the stamp duty value on the date of agreement and the actual consideration does not exceed 5,50,000, being the year of 50,000 and 10% of the consideration. At that time, you can show also, like however I explained here, you can also show, guys. Okay, inadequate consideration is 4 lakh. So check it. A year of 50,000 or 10% of actual sale consideration, which comes to 5,50,000, whichever is higher, 5,50,000. So inadequate consideration is not more than 5,50,000, hence not taxable in the hands of Mukesh. At the time of subsequent sale of property by Mukesh to Deepthi, short-term capital gains would arise in the hands of Mukesh. Why, sir? Because he has held it for more than 24 months. Sorry, less than 24 months. What is the period of holding applicable for immobile property? 24 months. Did he hold it for more than 24 months? No, he sold it within 24 months. That means what should we compute for Mukesh? Short-term capital gain. So full value of sale consideration, whatever is his sale value, take it, 65 lakh. And sir, actually stamp duty value is 64. When the sale value is more than stamp duty value, we should straight away take sale value. No need to compare, nothing. No 10%, nothing, guys. Straight away take actual sale value. Fine. So cost of acquisition is 55 lakh and short-term capital gain is 10 lakh. Question is silent about expenses on transfer and all. So you don't calculate any amount. Straight away allow only the cost of acquisition. And here as the asset is short-term, no indexation and all, guys. Fine. The last one. Discuss with logical reasoning whether the following are capital or revenue receipts and expenses. That is the first basic chapters, guys. An amount of 1,60,000 was spent by a company for sending its production manager abroad to study new methods of production. New methods of production, not for tripping tourism. to on business purpose. Can they claim it as revenue? Yes, they can claim it. Yeah. Revenue expenditure, amount spent by a company for spending its production manager abroad, for sending its production manager abroad to study new products of production is revenue expenditure. To be allowed as a deduction because the new knowledge and exposure of that manager will assist the company. So it is considered as company's expenditure only, guys, in improving its existing methods of production. It's a revenue. So don't consider it as personal and all, because as is going for the business purpose, business can claim it as an expenditure. B and Co received 4 lakh as compensation from C and Co for premature termination of contract of agency. It is a capital receipt but taxable. Capital receipt but taxable, guys. Capital receipt. Receipt in substitutions of a source of income is a capital receipt. Sir, what is that substitution of source? Guys, if agency contract was not terminated, the agent would have received commission. Now he is losing it. To compensate that, principal is paying what? Some compensation. That is what they have told in the first line. Therefore, the amount received by B and Co from C and Co, the premature termination of an agency contract, is a capital receipt, though the same is taxable under section 28, that is PGBP, guys, of the Income Tax Act 1961. Same to same item we have also solved in our class. Next, third one, payment of 60,000 as compensation for cancellation of a contract for the purchase of machinery with a view to avoid an unnecessary expenditure. Same to same item again we had covered in our regular class. Guys, I had entered into a contract to purchase machinery, but now I felt, no, I don't want to purchase machinery. I am cancelling that contract. In that case, sir, whatever compensation I am paying to the other party to cancel the contract, it is to avoid capital expenditure. In order to avoid the whatever capital expenditure I was supposed to incur, to avoid that I have cancelled the contract and I have paid the compensation. So what is it? This is the expenditure which I have incurred to avoid the capital outflow. So it is a capital expenditure, or we can also actually call it as capital loss. Capital loss, guys, because normally expenditure means which will give some benefit for us. This actually whatever compensation I am paying will not give any benefit. It actually saved me from incurring capital expenditure. Okay. This is a capital expenditure, as any expenditure incurred by a person to free himself from a capital liability is a capital expenditure. In the given case, the payment of 60,000 for cancelling the order for purchase of machinery has helped the assessee to become free from unnecessary capital liability. So it is capital in nature. Next, R Company Limited, instead of receiving royalty year by year, received it in advance in lump sum. Sir, it is still revenue. Why? How I receive it is left to me. Royalty is what? Revenue for me. Whether I receive it in lump sum or whether I receive it in installment, that is left to me and the other party who is paying it. Clear? The nature will not change, guys. Revenue receipt. Receipt of lump sum royalty in lieu of future royalties is a revenue receipt, as it is an income from royalty. As it is income from a royalty, which is revenue in nature. Okay, the last one, guys. One last item. An employee director of a company was paid 3,60,000 as a lump sum consideration for not resigning from the directorship. From not is also an employee director. Please be careful. So for not resigning from the company is paid. Oh, God employee. Revenue receipt. The amount of 3,60,000 received for not resigning from the directorship is a reward received from employer. Therefore, it is a revenue receipt and taxable. It is taxable for director where? Under the head salary, because it's the employee director. Please be careful. And where is it taxable and all, you need not mention. You just tell whether it is a revenue or capital, but I am just mentioning for your knowledge, guys. Yes. So this is all about the direct tax part, guys. So in the indirect tax part, I would be discussing it as a separate video, but direct tax, this is all about. Thank you, students.